We go now to Joel Griffith, Economist and Research Fellow at the Heritage Foundation. Joel, always great to have you on. First off, I want to get your take on this debt limit spending deal.
Oh, well, this is such a bad deal for the American people. Under this compromise, federal spending next year is actually likely to increase yet again. It only reduces a small portion of the overall budget. And we got to remember the federal budget right now is almost 50% larger than it was just prior to COVID. So basically what this compromise does, it freezes into place this enormous government expansion. And then starting next year, it starts increasing spending once again. It keeps in place so much of the Green New Deal, keeps in place funding for 87,000 tax agents. Even it fails to address the nearly $1 trillion in student loan forgiveness that Biden has proposed through changes to the repayment plans.
Joe, what would you have liked to see come out of this deal?
Well, I would have loved to see that any increase in the debt ceiling be met with real spending cuts. The initial proposal from Republican conservatives was to reduce federal spending by $4 for every dollar increase in the debt ceiling. But in exchange for what we thought was going to be a decent deal, we end up spending even more money. And we end up not just lifting the debt ceiling, they've actually scrapped the debt ceiling. There is no debt limit until the beginning of 2025, which is also something very important. The deal expires on January 1st of 2025, and that's an important date because at that point, we're going to have a lame duck Congress. We're going to have a lame duck president because the new Congress and new president won't be sworn into office for several more weeks. And that means a Democrat progressive president. And once again, a bunch of free spending people in Congress are likely going to go through this shenanigan all again and increase the debt ceiling yet more.
Joe, I want to go back, to the present day here. How have the markets been responding to this current news?
Well, the markets are up the last 2 days. It might be partially due to the fact that the debt ceiling was lifted. There was a lot of needless hysteria about a potential default. The administration and even some Republicans had tried to convince the public that we would default on June 1st. That was not the case. We would have seen a simple prioritization of spending. We had plenty of tax revenue coming in to cover Social Security, to cover defense spending, to cover interest on the debt. We would have simply had a partial government shutdown. All of this hysteria was manufactured, and it resulted in trillions of dollars of additional deficit spending.
Joe, it doesn't sound like you like this deal at all, but if you were to pick a winner, who would it be?
The winner, I would say, in the words of one of Biden's top economists, the winner are progressives, because this cements into place a lot of progressive spending proposals. Think about all the outrage that we saw just a year ago as conservatives when the Biden administration pushed through hundreds of billions of dollars of subsidies for solar panels and for wind turbines and for all of these green energy projects that are going to jump energy prices for the American people. This deal leaves that in place. Think about all the outrage, rightful outrage that we've had over all of the student loan forgiveness plans and the student loan freezes, forcing the majority of Americans who don't have a college education to pay the bills of those who took on college debt. This deal leaves in place up to $1 trillion of Biden plans to actually forgive yet more student loans. So this is an absolute failure for conservatives. And if you didn't like the inflation that we saw over the last 2 years because of all the money that was printed, we're not going to like at all the inflation that's going to be caused down the road because our central bank is going to have to print trillions of dollars to finance all of this additional spending that Republicans and Democrats just pushed through Congress.
Joe, we have a little less than a minute left, but I want to talk about the jobs report that was released today. What's your take on that, and what does it signal to you?
Well, if you dig a little deeper in the jobs report, it showed over 300,000 jobs created last month. But what's really interesting are that all of those jobs are actually part-time jobs. The number of full-time jobs has actually been declining. And this suggests that a lot of people are, by need, taking on multiple jobs because the full-time jobs are not there in abundance like they were before. Something else, a big takeaway from the report, are that wages did increase year over year by around 4%. But remember, inflation has been over 6%. So for the 23rd consecutive month, we've actually seen year over year, real wages decline. This is a continuation of that. Real families have lost around $7,000 in real wages the last 2 years. And the jobs report, I know the market is screaming higher today. That's because looking at that top line number. You dig a little deeper and you realize full-time jobs are actually declining.
Joe, we're going to leave it right there. Always great to have you on and get your insights. We appreciate it.
Thank you, Tracy.